Welcome back to the deep dive. Today, we're digging into Suncor Energy's third quarter results for 2025. And this isn't your standard earnings report.
No, not at all.
It feels more like, well, confirmation. Confirmation that a pretty huge organizational shift they've been promising for years might actually be delivering.
That's exactly it. Our mission today really is to unpack how they pulled off what they're calling record quarterly results across our businesses.
Right.
And maybe more importantly, focus on the predictability aspect.
Right.
Because, when you dig into the cash flow, it looks like they're not just riding high oil prices anymore.
Seems like they've engineered something more stable into the operation itself.
Precisely. That resilience, that ability to generate solid cash flow, even when prices aren't, sky high. That's the real story here, I think, for anyone watching the energy space.
And there's a lot of evidence stacked up. The sources mention records constantly. So we're going to track this transformation, starting with these really quite staggering operational wins in Q3, wins that actually forced them to raise their targets for the whole year.
Yeah, mid-year upward revisions, that definitely gets your attention.
Okay, let's start upstream. Q3 2025 was, huge for them. Total upstream production hit 870,000 barrels a day.
Which is a big number on its own.
It is, but the key thing, I think, is the comparison. They didn't just beat their previous best Q3, they smashed it.
Yeah.
By 41,000 barrels a day more than the record they set just last year.
And it wasn't just overall volume. If you look specifically at the oil sands biomass production, that hit 958,300 barrels a day. That's the highest ever quarterly number for the company.
Ever.
But here's the crucial link, and this points to that cultural shift you mentioned. They achieved this while also having their safest period ever.
Right, they specifically called that out.
Yeah, the first 9 months of 2025, fewest incidents, lowest severity. It really underscores that you don't get this kind of reliable peak production without deeply embedded safety practices. They go hand in hand.
Okay, so that's upstream. Let's pivot downstream. The refinery numbers were also pretty eye-popping, especially that utilization rate.
Oh, absolutely. Refining throughput was another quarterly record, 492,000 barrels a day. And they hit what they called an industry-leading utilization of 106% for the quarter.
106%? I mean, how does that even work?
Well, it means they're running those assets incredibly efficiently, pushing them safely beyond their sort of nameplate capacity through really smart operations and debottlenecking. Sarnia and Montreal refineries both set new records.
Running past 100% capacity while improving safety. That suggests, a whole different level of planning and execution than maybe they had before.
It really does.
And what did all that efficient refining mean for actual sales? Did it translate?
Directly. Refined product sales also hit a new record, 647,000 barrels a day. And this kind of brings us to that aha moment for anyone watching.
Which is?
That after a quarter like Q3, which often involves maintenance downtime, they didn't just meet the forecasts, they blew past them so decisively, they had to tell the market, okay, we need to aim higher for the whole year.
And this wasn't just tweaking the numbers, was it? These were significant guidance bumps.
No, quite significant.
Yeah.
Total upstream production guidance, the midpoint went up by 25,000 barrels a day. The new range is 845K to 855K barrels a day.
And downstream.
Even bigger jump there. Refined product sales guidance, the midpoint was lifted by 45,000 barrels a day. So they're now targeting 610K to 620K barrels a day. It's like they fundamentally reassessed what their system is capable of producing reliably.
So how did they do it? What's the underlying engine driving this?
Well, the sources point squarely at their internal operating framework, this Operational Excellence Management System, or OEMS. It seems to be the bedrock.
OEMS, okay.
It's this systematic approach that, it seems to have mandated a complete rethink of their maintenance philosophy. They talk about adopting an industrial engineering mindset.
Meaning what, exactly? Less variation, more predictability.
Precisely. Systematically rooting out variation, driving efficiency, making sure things run smoothly and predictably. And a huge piece of that puzzle is the turnaround program.
Right, the maintenance shutdowns. That seems absolutely key. They said every single turnaround in 2025 came in under budget and in record time.
Every single one. And that's critical because turnarounds are, necessary, but they're expensive periods of non-production. Getting them right changes the game.
And they're benchmarking this improvement.
They are. They noted the whole 2025 turnaround program is getting close to the second quartile for performance in North America, which, for Canadian assets, is basically best in class.
And the cost savings.
Pretty substantial.
Yeah.
Historically, that annual program cost around, say, CAD $1.25 billion. Now, they expect the new norm to be under CAD $1 billion.
Okay, so that $250 million difference, that's not just saved cost, right? That's the cash flow they didn't have before.
Exactly. Predictable cash flow freed up. And to make it really concrete, the Montreal refinery turnaround example is perfect.
Let's hear it.
Okay, so this was work that in the past took 55 days. They budgeted it for 50 days this time, which was already seen as pretty ambitious.
Right.
But the team executed it in just 40 days. 40.
Wow. From 55, historically budgeted 50, done in 40.
And that efficiency jump literally moved their performance on that metric from the industry's bottom fourth quartile straight up to the second quartile.
Okay, 40 days is impressive for speed. But cutting maintenance time that drastically from 55 down to 40 days, does that raise flags? Are they potentially sacrificing long-term reliability for short-term speed? Did the sources address that risk?
They did, implicitly at least. They emphasized this isn't about cutting corners. It's about rigorous engineering and meticulous planning driven by that OEMS system. It's about doing the same work, or better work, much more efficiently planned and executed.
Yeah.
And the cost reinforces that. It wasn't just faster, it was cheaper. That same scope used to cost around CAD $80 million. They budgeted CAD $71 million for it this time.
And the actual cost?
Came in at CAD $62 million. So faster and significantly cheaper. It's kind of the proof point that the system overhauls is working.
And I guess the ultimate vote of confidence in this new maintenance approach is that they're extending the time between these major turnarounds.
Exactly. That's a huge lever. Better, more effective maintenance means you can trust the assets to run reliably for longer. So upgrader 1, the interval's gone from 5 years to 6 years.
1 extra year of continuous operation.
Right. And at the Edmonton refinery, for a whole block of units, they've pushed intervals from what used to be 3 or 4 years out to a planned 5 or 6 years.
That's potentially 50, even 65% longer run times between major spending and downtime just on those units.
Over 2 cycles, yeah. And again, they stress this is based on detailed engineering assessment and monitoring, not just picking a number. The CEO apparently was quite direct, dismissing the old idea that old assets couldn't perform as basically an excuse for subpar performance.
So a real philosophical shift. Less excuse-making, more engineering the variation out.
That's the idea. More predictable, more ratable results.
Which sets us up nicely to look at the financials. Because that operational discipline, that predictability, it should absolutely show up in the cash flow numbers. And we should mention this all happened during a CFO change. Chris Smith retiring, Troy Little stepping in.
Right, and the numbers really do reflect that engineered resilience. What's fascinating is looking at cash flow relative to oil prices.
Yeah.
Q3 adjusted funds from operations AFFO was $3.8 billion.
Okay, $3.8 billion.
But here's the kicker. That was achieved with West Texas Intermediate, WTI crude, averaging only $65 a barrel.
$65. That feels moderate, right? Not exactly boom times.
Exactly. And they point out the last time AFFO hit that same $3.8 billion mark, that was Q3 2024 WTI, was averaging $75 a barrel.
Wow. Okay, hold on. So they generated the same level of operating cash flow with oil prices $10 lower.
That's what the numbers show. It strongly suggests they've reduced their dependency on high prices. They've built a stronger base level of cash generation.
That's a powerful indicator. What about free funds flow after capital spending?
Similar story there. Free funds flow, FFF, came in at CAD $2.3 billion in Q3. That's the highest operational FFF they've seen since way back in Q4 2022.
And what was WTI doing back then?
Averaging $83 a barrel.
$83. So $18 higher crude prices back then, generating comparable free cash flow to today's $65 world? That difference really highlights the operational leverage they've gained.
It absolutely does. That delta, that $18 difference, it confirms that lower reliance on just the commodity price.
Okay, so they're generating more predictable, resilient cash. How are they returning it to shareholders? What's the strategy there?
Well, they returned over CAD $1.4 billion in Q3 alone. That was split between dividends and share buybacks. They did approve a dividend increase, about 5%, up to CAD 2.4 euro per share annually.
So ticking the box on a reliable, growing dividend, as they say.
Right, confirming that commitment. But the emphasis, reading between the lines, and even in their direct statements, seems to be much more on the buybacks right now.
Why is that?
They bought back CAD $750 million worth of shares in Q3, and they specifically committed to continuing buybacks at CAD $250 million per month. They state pretty clearly they see repurchasing their own stock as the best investment for driving per-share value, especially at current prices.
Basically saying they think their stock is undervalued, given these operational improvements we've been discussing.
That's certainly the strong implication. It's a vote of confidence in their own transformation.
And this shareholder return is all supported by careful capital management, right? They're not breaking the bank to do this.
No, quite the opposite. The core principle seems to be keeping annual capital spending under CAD's $6 billion. For 2025, they expect to come in at the low end of their revised range, which was CAD 5.7 to 5.9 billion.
Spending less, generating more.
That's the goal. And that discipline has had a dramatic effect on the balance sheet. Net debt is down to $7.1 billion.
Okay.
And get this, their net debt to trailing 12-month AFO-VARO ratio is now just 0.5 times.
0.5, what was their target?
Their stated target was 1.0 times, and that was based on a conservative $50 WTI assumption. So they're already well below target, even with oil higher than $50 but lower than, say, $80.
So they've blown past their debt target already.
So much so that they mentioned they're now actively reviewing their longer-term $8 billion net debt target simply because they're deleveraging much faster than they probably anticipated.
Okay, remarkable turnaround on the financial side, clearly driven by the operational side. But there's one more piece Suncor always emphasizes. It's integration, this end-to-end control.
Right, from the oil sands mine right through to the Petro-Canada gas pump. The CEO used this analogy of being able to make craft cocktails for customers.
Craft cocktails. Okay, explain that one.
I think it means they have this intricate control over the whole value chain. They extract specific types of crude, they process them in their own complex refineries, and then they blend and sell specific fuel formulations directly to customers.
So it's not just about digging stuff up and selling it on the open market.
No, this unparalleled integration, as they call it, lets them capture margin at multiple points, and crucially, helps insulate them from some of the wild swings you see in specific market differentials, like the difference between heavy crude prices and refined product prices. It adds another layer of resilience to the cash flow.
We talked about reliability improvements driving production, but are they also unlocking just raw capacity upstream beyond just running things better?
Yes, there are examples of that too. At Fort Hills, for instance, the mine is moving into new areas North Pit 1, opening up North Pit 2. The goal there is to push production volumes up towards 195,000, maybe 200,000 barrels a day over the next couple of years.
Okay, so some organic growth there.
And look at Firebag. They're in situ operation. Production there in 2024 averaged 234,000 barrels a day. Compare that to 2022, when it averaged just 199,000. That's a big jump.
And was that from new investment?
That's the key. They achieved that increase without significant new growth capital. It was primarily through operational optimization, applying that OEMS discipline. Pure efficiency gains unlocking barrels.
Okay. And in downstream, how does this integration show up in their sales strategy? Are they just pushing maximum volume?
No, it seems much more targeted. They talk about focusing on value and volume. The numbers back that up. High-margin retail sales through their own network were up 8% year over year.
And the alternative?
Lower-margin export sales. Those were actually down 11% year over year. So it looks like they're consciously choosing to direct their refined products towards the most profitable channel, which is their own Petro-Canada stations.
Makes sense. And is that strategy paying off in terms of market share?
It seems so. They mentioned the Petro-Canada retail network's market share is up 1.5% just this year. And they're investing there too, planning to rebrand 75 sites across Canada in 2025.
And the margin capture itself, is it strong?
Very strong, consistently. They reported capturing 92% of their benchmark refining margin index, the custom 5221 index. That reinforces the competitive advantage they get from owning the whole chain.
Okay, so boiling this all down, record results, raised guidance, efficient turnarounds, extended intervals, resilient cash flow independent of high prices, disciplined capital, smart integration.
It really paints a picture of, well, institutional change taking root. The financial results, the record metrics, they aren't the cause. They feel like the outcome. The outcome of getting that operational excellence management system, the OEMS, working properly, getting all the pieces, systems, people, processes, finally working in sync, as they put it.
It feels less like a temporary peak and more like a new baseline.
That seems to be the argument. A structural improvement that creates what they hope is a unique and premium value proposition for investors looking ahead.
And it really does seem like this deep dive shows a company that's, well, maybe fundamentally changing its stripes. The CEO was pretty blunt, wasn't he? Saying that comparing Suncor just to its Calgary peers, that's not really the right comparison anymore.
Yeah, implying their integrated model, combined with this operational push, sets them apart within Canada.
Which leads us nicely to our final thought for you, the listener, to chew on.
If Suncor is right, if their specific integrated setup and this OEMS-driven performance really do make them fundamentally different from other Canadian oil sands players, well, then who should you compare them to?
Right. What kind of global energy company, or maybe even a high-performance industrial complex totally outside of oil and gas, provides a better yardstick for judging where they go next? It forces you to look beyond the usual neighborhood, doesn't it?
This certainly does. Something to think about.